despite the continued moderation of food price inflation at the CPI level, having measured 4.6% in May and 4.3% in June. However, the continuing drought in parts of the country have contributed to the upside risk to the outlook, despite benign food price inflation. Maize and wheat prices have increased significantly since the beginning of the year, and we are yet to see the full impact on consumer prices. At the PPI level, however, cereal and crop price inflation accelerated to 17.8% in May, and both wheat and maize prices are now trading at around import parity levels. International oil prices have been somewhat weaker since the previous meeting of the MPC, following higher output by Saudi Arabia and the prospects of a resumption of oil exports by Iran. This follows 2 consecutive months of oil prices in the range of 60 to 65 US dollars per barrel. Since early July, spot prices have traded below $60 per barrel, while futures prices are currently trading at around $58 per barrel for December delivery. The bank's forecast assumes a moderate increase in oil prices over the forecast period. Domestic petrol prices have increased by about 90 cents per litre in the past 2 months, but should current level trends persist, a price reduction of around 40 cents per litre is likely in August. Whilst the June inflation outcomes were below expectations, this respite is expected to be temporary. The persistence of forecast inflation at elevated levels and the continued upside risks to the outlook remain a concern to the MPC. Although inflation is currently within the target range, given the lags in monetary policy changes on inflation, the focus of monetary policy continues to be on the medium trend and to ensure that inflation remains comfortably and sustainably within the target range. Inflation is expected to breach the upper end of the target range for 2 quarters, and the medium-term trajectory remains uncomfortably close to the upper end of the target range. The upside risks make this trajectory vulnerable to any significant changes in inflation pressures. Although the risks of higher electricity tariffs did not materialize as yet, other upside risks persist. The rand remains vulnerable to global market reaction to US monetary policy normalization, particularly in the context of South Africa's twin deficits. The pressures on the exchange rate have been exacerbated by the recent significant decline in commodity prices, which are likely to impede the favorable current account adjustments. Some of the rand adjustments has already occurred since the previous meeting, but further reaction to US monetary policy tightening could cause inflation to diverge even further from target and set in motion an exchange rate inflation spiral. Further upside risks are expected to come from food prices, which are yet to react to significant increases in spot prices of agricultural commodities. The MPC has indicated for some time that it is in a hiking cycle in response to rising inflation risks and a normalization of the policy rate over time. The MPC is cognizant of the fact that domestic inflation is not driven by demand factors, and the outlook for household consumption expenditure remains subdued. Economic growth remains subdued, constrained by electricity supply disruptions and low business and consumer confidence, and the risks to the outlook remain on the downside. However, as emphasized previously, we have to be mindful of the risks of second-round effects on inflation, and the committee is concerned that the failure to act against these heightened pressures and risks will cause inflation expectations to become entrenched at higher levels. The MPC has therefore decided to continue on its path of gradual policy normalization. Accordingly, the repurchase rate will increase by 25 basis points to 6% per annum, with effect from Friday, the 24th of July, 2015. 4 members favored a 25 basis point increase, while 2 members favored an unchanged stance. The expected inflation trajectory implies that the real repurchase rate remains low and possibly still slightly negative at times and below its longer-term average. The monetary policy stance, therefore, remains supportive of the domestic economy. The continuing challenge is for monetary policy to achieve a fine balance between achieving our core mandate of price stability and not undermining short-term growth unduly. Monetary policy actions will continue to be sensitive to the extent possible to the fragile state of the economy. As before, any future moves will therefore be highly data dependent. Let me at this stage invite you to pose your questions. We did, in addition to the statement, include for you an annexure with our assumptions, and they are part of the statement. I know I'm cognizant that they might have delivered after the statement was delivered, but they are part of the statement. Shall we take the questions? And as usual, please identify yourself and the media house that you represent, and we would see how we distribute the questions from this side. Right at the back. Miriam.
Oh, thank you. I think the last speaker to work. I noticed that your assumptions are based on a repo rate. It's Mary Lucy from the Sunday Times. Your assumptions are based on a repo rate of 5.75%, and it's now going up to 6%.
How will this change how is this likely to change your inflation and growth assumptions among the others?
Next question. Renee?
Governor, it's Renee Volgraaf from Bloomberg News. Governor, I'd like to know, what does the MPC hope to achieve with this interest rate increase, given that you have pointed out that the inflation is not demand-driven? And then also, what about the possible negative impact on growth? I mean, we are not in a good position there.
Right at the back.
Hi, Governor. Thanks. It's Hannah Barry from MoneyWeb. I wonder if you can speak a little bit to what or how seriously the Reserve Bank considers the US raising rates in terms of further rate increase. So is it very concerned to get another rate increase in before the US hikes rates? Thanks.
Last question in this round.
Oh, sorry, Ed Stoddard with Reuters. Well, I'm just wondering why 25 basis points and not 50 basis points. Thanks.
Maybe, Ed, we start with you. Why not 0 and 25 basis points? The point is that in making a policy decision, you assess the risks to the inflation outlook, you assess the risks to the growth outlook, and then you take a stance. And as you would see in the statement, we assess the risks to the growth outlook to be slightly on the downside. And we do also state that we are cognizant of the fact that the domestic economy is fragile. We had previously stated that South Africa is increasingly facing a typical monetary policy dilemma of slow growth with either rising inflation or inflation that is stuck at the upper end of the range. And over the forecast period, for 2 of those quarters will actually be outside of the target range. In taking steps to deal with those risks to the inflation, it is important that you take these steps cognizant of the fact that you are in an environment where growth is actually fragile. And after assessing the risks to both growth and to inflation, we came to the conclusion that 25 basis points would be an appropriate step to take at this stage. Hannah Berry, you asked the question about how seriously do you take the U.S. Raising rates? Well, I guess everybody else does, so should we. And the U.S. is still the largest economy in the world. Developments in the U.S. affect various economies across the globe. When the U.S. adjusted policy rates lower and ended up on the zero lower bound, and when the U.S. started embarking on a process of quantitative easing, we were affected. We experienced a surge in capital inflows. We experienced an appreciation of the currency. We also did experience a protracted period during which inflation was slow for a long time. During that period, we were able to adjust monetary policy rates lower. Now, with prospects of the U.S. starting to move towards normalization, and indications from the U.S. policymakers are that it would be sometime this year, we expect that these capital flows that we had experienced might start to reverse. And it's not just for South Africa, it's for many emerging market economies that benefited from this surge of capital inflows from the United States. Now, the question is, when this happens, how does it affect the inflation dynamics in South Africa? We expect that when the normalization starts in the US, you will experience a repricing of South African assets. And this repricing of South African assets will be mostly pronounced through the exchange rate of the rand. And the thing for monetary policy authorities, that, including the South African Reserve Bank, would be when you see that happen, you take a stance and ask yourself, is this only a once-off thing, or could it lead to second round effects? And if you believe it would lead to second round effects, then you would have to adjust policy. Otherwise, you are going to have inflation running out of your target range. So our attitude and our approach is not to say the US is moving, therefore we are moving. Our approach is, when the US moves, what are the implications for the economic outlook in South Africa? And as such, we then respond to we respond to that. I guess that tells you how serious we are. Renee, the question of what do we hope to achieve with these increases? Well, we are hoping to achieve what we started in January last year. You see, when we started in January last year and we said that there are risks emerging on the inflation outlook, that we are worried about inflation expectations being anchored on the upper side of the inflation target and at times outside of our inflation target range, that we were concerned. There were a number of other risks at the time that were contributing to the bad inflation outlook. And we started at that time, and we did a further adjustments in July. And when we got a respite from declining oil prices, we said that we are pausing. And when we decided that we are pausing, the question came at the time, why don't you adjust the rates lower? And we said, we want to see through the cycle. We want to see that, one, the decline in the oil price is persistent, and secondly, we want to see that the decline in the oil price leads to second round effects on the price side, meaning that it would lead to lower prices. From that period to now, we had seen that those declines in the oil price got reversed to some extent. And so I guess this is the tool we have to deal with inflation, and we are hoping that by continuing on the process that we started in January last year, we will get inflation anchored within our inflation target range. Miriam, assumptions have been based on a 5.7% increase. You know, when the staff of the bank do the forecast, they have to make an assumption. They didn't know that 4 members might favor an increase and 2 might say keep it the same. And the easiest assumptions for them to make is to say that it would be the same. In the table, what you will find is that we had put this assumption of a constant policy rate, and we said what would be what would be growth, what would be inflation, thus going forward. As data comes through, and as the next MPC comes, we will look at the data, we will look at the assumptions and see whether the assumptions are still valid, and then we will make a new stance. Any other questions? Hillary.
Governor, you said that 4 were in favor and 2 were against. Can you give us a flavor of the arguments, the focus of the arguments for and against?
Any other question? Yes, Candice.
That's Peter Montalto. Could you please comment on what you will be monitoring to see the impact of today's hike on inflation and particularly growth in the coming months, and how that might impact your future rate decisions?
Any other question? Renee?
Sorry, Governor, this new machine is above my level. Governor, South Africa is now one of several African countries which have raised interest rates this year, and in a lot of our neighboring countries or countries up north, it seems like central banks are raising interest rates to help prop up their currencies. So what is the MPC's expectation with regards to today's decision on the rand? And I mean, what's the effect of the rate on the rand discussed by the MPC?
Any other question? Was that the last one? Candice?
It's Danielle Marcia. Could you please explain the reason behind the moderately higher inflation forecast over the coming quarters in the context of the recent positive surprise in CPI?
Gentlemen, Hillary, let's start with you. Daniel, you're going to deal with Peter Montalto's question. And Brian Khan, Danali's Masia's question. And Rashad, will you deal with the Renee's question on what we think this will do to the exchange rate and all of that stuff? What were the arguments, Hillary, for and against? They are adequately captured and well articulated in the statement. You will see in the statement that we spell out quite clearly what the growth considerations are and the risks to the growth outlook. We spell out quite clearly what the considerations are with respect to the inflation forecast and what the risks are to the inflation forecast. Based on that assessment of risks, the committee came to the conclusion that this is the stance that we should take. Rashad, you're going to go first.
Thank you very much, Governor. Thank you, Renee. Look, it would be naive for us to think that we can use the interest rate to prop up currency. I mean, that does not deny that there must be some relationship between differentials in interest rates between us and trading partners and so on. But I think the critical thing was that our decision was really based on our view of the risk of second round effects, or the potential risk of second round effects, the potential risk coming from the latest inflation expectations data and so on. So it is a classic response to our interest rate increases, classic response to what we see as a risk to the inflation outlook, and not more.
Brian?
Thank you. In response to the question from Donnelly concerning our forecast in the light of yesterday's inflation outcome, I think it's important to emphasize that our forecast was based on data that we had before yesterday. Clearly, the modeling team did not have an opportunity to incorporate the latest data point fully. However, just 2 points should be made. The one is that our forecasting model is based on quarterly data. So one data point has a relatively small impact on the overall inflation trajectory. So it's not clear exactly how big an impact that would be. The second point is that a part of the, or significant part of the downside surprise in yesterday's numbers came from food prices. Much lower food prices. We had expected to see a turn in food prices earlier or by this time, and the inflation rate was still declining. As we noted in the statement, we do expect food prices to start accelerating during the second half of the year, and these are already reflected in some of the producer price categories.
And just to say, Donnelly, that the fact that, yes, there had been a positive surprise, but the inflation in June is still higher than the inflation in May. It just so happens that a number of forecasters expected inflation to come at 4.9 or 5%. So they were surprised that it came in lower. But be that as it may, inflation in June is still higher than inflation in May. Dan?
Good afternoon, Peter. Thanks for your question. As you know, monetary policy works with a lag, and the question around what specifically we would be monitoring with regard to the impact of this policy adjustment today is a bit difficult one to answer. I don't think there's anything specific that we would have isolated and say going forward, these are the kind of issues you would look at. It will be the totality of the data set that we look at, the high frequency data that comes out, and obviously some of the risks that we've identified as being of concern with regard to the future inflation outcomes. We will continue to monitor, but it's not something that I suppose we could come back to you at the next or maybe the meeting thereafter and tell you that that's what we have seen, because these things work through various channels and with a lag. But it'll be the usual assessment of all the factors that might have a bearing on the inflation outcomes.
Is there anything that anyone wants to add? Well, thank you very much for your attendance. That concludes the proceedings of today.